piece of paper, and $100 oil. How marine insurance decides the price of petrol and diesel. Imagine this: one of the world's largest oil tankers is moving toward the Arabian Sea carrying millions of barrels of crude oil. Everything on the ship looks normal. The engine is running, the crew is busy with their work, and oil prices are constantly changing in markets around the world. But suddenly a decision is made that stops this massive ship in the middle of the sea. No missile has been fired, no storm has arrived, no pipeline has broken, yet the ship cannot move forward. The reason? Just a piece of paper. A piece of paper called marine insurance. And this small piece of paper can decide whether tomorrow petrol at the pump in your city will cost 100 rupees or 150 rupees. Rising tensions in the Middle East have once again reminded the world how fragile the global economy is, especially when the issue is energy, meaning oil supply. In recent months, growing conflict between Iran and Western countries has turned the Strait of Hormuz into the most sensitive sea route in the world. This is the place that many economists call the artery of the global economy. Because if pressure increases on this artery, the entire world economy begins to struggle to breathe. Geographically, the Strait of Hormuz is not very large. It is only about 39 kilometers wide. But its importance can be understood from the fact that about 20 to 21% of the world's total seaborne oil trade passes through this route. Nearly 20 million barrels of crude oil every day travel through this narrow passage to reach different countries of the world. Most of the exports from oil-producing countries such as Saudi Arabia, Iraq, Iran, Kuwait, the UAE, and Qatar pass through this route. When tensions increase in this region, the danger is not only from missiles or warships. The real crisis is related to the security and insurance of ships passing through the area. That is why, as soon as tensions increased in the Middle East, several major insurance companies stopped providing war risk cover for the Persian Gulf. This decision may sound small, but its consequences are enormous. Without marine insurance, no ship can legally carry out a commercial voyage at sea. This insurance does not protect only the ship owner. It also protects the cargo owner, the bank, the port authority, the crew, and the charter company. If a ship sinks, comes under attack, or the cargo is destroyed, who will cover the loss of millions of dollars? This is the question marine insurance answers. In fact, marine insurance works like a global permission slip. Without it, a ship's journey becomes almost impossible. Banks do not issue letters of credit, ports do not allow the ship to dock, and sometimes even the crew refuses to work on such ships because their safety and compensation depend on this insurance. Most of the world's marine insurance contracts are decided in the London market. Institutions like Lloyd's of London and several large insurance syndicates determine the price of maritime risk. Along with them, a joint war committee also operates, which decides which sea regions of the world will be considered high-risk zones. When a region is declared a war risk area, the insurance premium for ships passing through that region suddenly increases. For example, if a $100 million oil tanker normally pays around $2,500,000 as insurance premium per voyage, then in a war risk zone the same premium may increase to $3,750,000 or even more. And if the risk increases too much, insurance companies simply stop providing coverage. This is exactly what has happened in the Middle East right now. Several companies have withdrawn war risk cover because the reinsurance market, which carries a large share of these risks, has reduced its capacity. India's government-owned company GIC Re is also one of the world's major reinsurers, and during such crises their role becomes very important. Marine insurance actually works in multiple layers. The first layer is hull and machinery insurance, which covers the ship's structure and machinery. If the ship is damaged, this insurance pays for repairs or compensation. The second layer is cargo insurance. This protects the goods loaded on the ship. If oil, gas, grain, or any other cargo is lost or damaged at sea, compensation comes from this insurance. The third layer is protection and indemnity insurance, commonly called P&I insurance. This covers third-party damage caused by the ship. For example, if an oil spill damages the environment or if the ship collides with another vessel, compensation is provided through this insurance. Above all these layers lies the most sensitive layer, war risk insurance. This insurance covers risks such as missile attacks, sea mines, terrorist attacks, or war situations. An important feature of this insurance is the quick cancellation clause. This means that if the risk in a region suddenly increases, the insurance company can cancel the coverage with very short notice. That is why in the current Middle East crisis, more than 150 oil tankers suddenly became stranded. They did not have valid war risk cover, and without insurance they could not move forward. This immediately affected the global oil supply. According to some reports, ship movement in the Gulf region dropped by nearly 80%. Where earlier more than 130 large tankers passed every day, that number fell to fewer than 30. This means the massive flow of oil suddenly slowed down. When supply decreases and demand remains the same, prices are bound to rise. History also provides many examples where conflicts on sea routes shook the oil market. During the Iran-Iraq tanker war in the 1980s, more than 500 ships were attacked in the Persian Gulf. At that time, the US Navy had to escort many ships under military protection. Similarly, In 2023, attacks by Houthi rebels in the Red Sea forced many shipping companies to change their routes. Ships had to travel around Africa through the Cape of Good Hope instead of using the Suez Canal, which multiplied both travel time and cost. But the case of the Strait of Hormuz is even more serious, because here there is no alternative sea route. If this passage closes, most of the oil coming out of the Middle East is directly affected. Countries in Asia, such as India, China, Japan, and South Korea, depend heavily on Middle Eastern oil. India imports nearly 60% of its crude oil from this region. Therefore, if tensions increase in Hormuz, it can affect the prices of petrol and diesel in India as well. Oil market prices are not determined only by supply and demand. Geopolitics, shipping costs, insurance premiums, currency values, and strategic reserves also play important roles. When marine insurance becomes expensive, shipping companies add that cost to freight rates. Then oil traders include that cost in the crude oil price. After that, refineries and fuel companies buy the same expensive oil, and ultimately the impact reaches the common consumer. In other words, a decision taken about insurance in the middle of the ocean becomes visible at a petrol pump thousands of kilometers away. Many countries have created strategic petroleum reserves to deal with such crises. The United States has the world's largest strategic oil reserve, capable of storing nearly 700 million barrels of oil. India has also built its own reserves in Visakhapatnam, Mangalore, and Padur. But these reserves can provide relief only for a limited time. If sea supply remains disrupted for a long period, the world has to search for new routes, new suppliers, and new energy strategies. In today's global economy, energy is not just a commodity. It has become a part of political power, economic stability, and national security. That is why the entire world keeps its eyes on a small sea route like the Strait of Hormuz. This crisis in the Middle East also reminds us how complex and interconnected the world's economic system is. Sometimes a war, a sanction, or even just an insurance policy can shake the entire global market. And perhaps that is the most interesting aspect of this story, that between millions of barrels of oil, thousands of kilometers of sea routes, and billions of dollars in trade, sometimes the final decision is made by just a single piece of paper. A piece of paper called marine insurance, which quietly decides how fast the heartbeat of the global economy will run.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestion. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.